Hey guys, welcome to the Bumpy Road to $10 million. After about 2 decades of investing both my own and other people's money, I'm now sharing the details behind the investment strategy I would follow if I could start over in my 20s or 30s. What's so special about this strategy? Well, I believe it can help someone who starts investing just $500 a month at age 23 potentially have a portfolio worth over $10 million by the time they are in their late 40s. This strategy is high risk, but with potentially very high rewards and hopefully not too difficult to follow. So if you think this is something for you, then stick around, like and subscribe below, and keep watching. But please note, this is not financial advice. You should always do your own research before investing. This is the graph that we'll keep coming back to throughout this video series. You can see the projected dollar value of the account here on the y-axis and the number of years you're invested in the strategy on the x-axis. The portfolio grows exponentially over time, especially here in the latter years, and is projected to hit $10 million in year 24. And while that graph looks nice and smooth, the journey will more realistically be something like this. Our experience will be more like the crazy, volatile green line rather than the smooth blue line, hence the title, The Bumpy Road. Now, when it comes to investing for the long run, the classic advice you may have heard from the likes of Benjamin Graham and Warren Buffett is put your money in index funds and forget about it until retirement. And honestly, that is pretty good advice because it's a low-maintenance strategy that replicates the returns of the general US stock market. So over the long run, it's likely to provide decent returns without too much volatility. Having said that, let's compare what the results would look like if we invested exactly the same amount of money in our strategy versus S&P 500 index funds. We just said that if things play out as expected, our portfolio will be worth $10 million at the end of year 24. Now, what do you think the dollar value of our account would be if we invested the same amount of money in the S&P 500 instead? Here you go. The dollar value would be around $550,000 compared to $10 million for our strategy. The difference is massive. Of course, investing in the S&P 500 comes with much lower risk. But an important thing to understand from the outset is that we are not investing in the strategy to minimize risk. We want to fly to $10 million, not drive, run, or walk to it. By investing in this strategy, we are swinging for the fences, taking calculated risks, and looking for potentially life-changing money at an age well before retirement. So hopefully this has piqued your interest. Now let's move on. So who am I? I'll quickly go over my qualifications because some people might feel they give me credibility, but honestly, they don't really matter. The most important things I've learned have come through trial and error. So quickly, I currently work at a global investment bank where I've been for the last several years. I've previously worked on the buy side in asset management, including in private equity, and the bulk of my career so far has been spent working in finance in New York City. I'm also a CFA charter holder, and I have an MBA from a top US business school. So if my qualifications are important to you, here they are, and I'll leave it at that. I'm not disclosing anything specific because, as you can probably tell, I prefer to remain anonymous for a number of reasons. Way more important than the qualifications, though, is the fact that close to 100% of my net worth, excluding cash, is tied up in this strategy. So if things go wrong, I will be the first to be harmed. Okay, so as you can probably tell by my voice tone changing at random times, this is my first time making any kind of online video series. Rather than do any beautiful editing or learn that from scratch, I thought I'd just play some guitar. So let's jump straight into it. We will start with simplifying assumptions and what you need to believe for the strategy to work and for these projections to play out. We will go through them very quickly because in this video, I primarily want to focus on the results, but in future videos, we will discuss the assumptions in detail. So assumption number 1, we will turn 23 on December 31st, 2025 and start investing straight away with initial capital of $1,000. After that, we will invest $1,000 every 2 months. So $1,000 on February 28th, another $1,000 on April 30th, and so on. This effectively means we are investing $500 per month. Assumption number 2, and this is probably the most important assumption, that is that the S&P 500 index will increase by 9.5% per year for the foreseeable future. This is another way of saying the general US stock market will increase in value by 9.5% per year. We'll get into why we made this assumption in more detail in future videos, but just for reference, the average annual S&P 500 return over the last 25, 50, and even 100 years with dividends reinvested are somewhere between 10 to 12%. So I certainly wouldn't call 9.5% an aggressive assumption. Simplifying assumption number 3, we are investing in a portfolio of securities that will earn 2.7 times the S&P 500 return on average. We will discuss exactly how to construct this portfolio in a lot of detail in the next few videos, but effectively, this means that if on a given day, the S&P 500 index returns 1%, our portfolio will return 2.7%. On the other hand, if the S&P 500 returns negative 1%, our portfolio will return negative 2.7%. So you obviously have a lot of upside, but you have to take on the downside as well. Assumption number 4 is that there will be no day in the next 30 years where the S&P 500 will lose more than 30% in a single day. Even if this happens, as we will see later, our portfolio will still be well protected. But we assume this scenario will not happen because the largest ever single day loss for the S&P 500 was around 20%. The last assumption is we are living in a world with no capital gains tax. Obviously, that won't be true for a lot of you, but I am absolutely not qualified to give any kind of tax advice, and people will have many different tax situations depending on where you're living. As a very rough approximation though, if you live in the US and have to pay a long-term capital gains tax of 15%, it will likely take an extra couple of years to arrive at the $10 million mark. If you believe these simplifying assumptions, and on the 0.001% chance they play out exactly as expected, this is what your hypothetical portfolio account balance could look like over time. This is the graph we showed at the beginning of this video. Now let's look into the numbers a little bit. In the first year, you would have invested $7,000, and at the end of the year, you would have $8,000. Doesn't seem like a lot. Fast forward to year 5 though, you are now 28 years old, you would have invested $31,000, and the value of your portfolio would be $62,000. In year 10, you are 33 years old, would have invested $61,000, and your account balance would be significantly larger than what you had invested at $277,000. Now maybe you're starting to notice a pattern here. Time, consistency, and compound interest are your best friends. The more patient you are, the greater the difference between what you invested and the expected dollar value of the account. Let's go all the way out to year 2049. Hopefully, you've been exercising, eating clean, meditating, and doing all that good stuff. You are now a fit 47-year-old with many, many good years ahead of you, and if things go according to plan, you have an investment portfolio worth over $10 million. And while you can keep going, it is at this point that I personally plan on exiting from the strategy if everything works out and investing the money in almost risk-free assets to enjoy the rest of my life. Now again, this assumes things have gone exactly to plan. Will that happen every year? Absolutely not. As I mentioned at the outset, your portfolio value is more likely to look like this volatile green line than the smooth blue line. However, on average, I believe things will balance out. You need to be brave, have a thick skin to see this through. You also need to be comfortable with the fact that you are taking a real calculated risk, which can have consequences. So guys, in this video, I tried to present you a very high level and quick overview of the strategy while focusing mostly on the potential results and showing you the art of the possible. I cannot tell you for sure this strategy will work as expected, but what I can tell you is the vast majority of my personal investable capital at the moment is in this strategy because I feel the upside is way too good to ignore. If the strategy completely fails, I will lose a lot of money. However, if I was to go back in time to when I was 23 years old, I know what I know now, and I could afford to put away $500 a month, I would absolutely follow this strategy and forget about trying to buy individual stocks, time the market, and so on. Before I end, a quick but very important note that we mentioned at the beginning. This is not financial advice. This is my personal investment strategy and journey shared for educational purposes. While we aim to mitigate risks as much as possible, there is a real chance we can lose everything. So I really encourage you to do your own research and not just blindly follow what I have to say. So I will stop there for today. In the next few videos, we will share what specific securities we need to invest in to make the strategy work, and also flesh out the assumptions in more detail because they are very important. Later on, you'll also see exactly why this series is called the Bumpy Road to $10 million, as I will also share my personal investing journey and how this strategy has performed for me over the last 5 years, including in 2022, when my portfolio was 60% behind target. So thanks for your time, guys. Please like and subscribe below, and I look forward to seeing you on the next one.